The next thing I want to introduce to you is about the differences between the forward and futures. So you have two terms, forward and futures. So why we have two products in the market, and is there any special about the futures compared to the forward or not? So the answer is that yes. The short answer is yes. But what are they? So I will go very quickly to this point, and I hope that you can get the main point from this differences, because I think it's important in the first lectures. So the idea is that in short, the forward is in the OTC market, is in the unlisted market, but the future is in the listed market. So it means that the future is more likely to be more standardized. The products in the future is also very standardized, and is have the the, 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 the the fixed quality and requirement for everyone. So you can think about it's very similar to the stock market. We have the listed market, right? NYSE. In Taiwan, we have the TSE, something like that. So the stock there are very standardized and very all the information is very clear. But for the OTC market, it's more likely to be uh, can be customized, depends on the requirements of the customer. So normally in the future market, everything will be more the exchange will have some requirements to protect the investor. So one of the key things to remember here is I will make you some slide to introduce about the future contract. For example, is available to a wide range of assets. Is trade in the exchange, right? Is specification need to be defined. Everything in the contract is very standardized by the strengths. And the last thing is the price and the profit and loss of every positions, the long positions and the short positions will be settled daily. So what does it mean? It means that we have the every long and short positions. If you come into the future contract, if you buy the future contract or you sell the future contract, you need to have one margin account. So what is a margin account? This is a cash or marketable security that is deposited by the investor where at the broker, right? So you go to the broker. If you buy the future, you need to open the margin account and put the cash inside. So the balance in the margin account is adjusted to reflect the daily profit and loss in the market of your positions. So they will look at your positions and can recalculate every day the settlement and the balance of the margin account. And the margin account need to be uh, check daily, and whenever it is too low, the broker will call you, and people call that action is a margin call. They will call you and ask you to put more money if you lose so much money in one day. So that is a margin call margin. And it's very important to protect the to mitigate the default risk of the one side. So what is a default? It means the one or two positions in the contract they get default, they cannot fulfill, they cannot pay the loss. So to minimize the default risk, the strengths and the future market require you to have the margin account. So let me give you one example to understand about the margin accounts. So in the margin account, for example, we have one investor have the long positions, so he will buy something, right? He buy two contract on June 5th. So the two here is a what? Two December contract. It means that he will buy two contract, and the maturity date is in December. The contract size is a 100 ounce. The future price now is a $1,450 um, per ounce, right? The initial margin requirements is mean that If you buy these two contracts, so you need to pay you need to put into your margin account is a $6,000 per contract. But we buy two contracts, so that's why you need to put into the margin account is a $12,000. The maintenance margin account is what? That is the minimum balance you need to have in your margin account. So later we will see that the maintenance margin is very important. So why they are so important? So we will check later. But what the maintenance margin account in this case is a maintenance margin is 9,000 in total. So you need to put into the margin account is 12,000, and you remember that we have a maintenance margin is 9,000. So why 9,000 is important? Let's see the next table to see the example. So this is our data, our daily settlement from day 1 until day 16. Okay. So the on the first day we put into the account 12,000, right? And by the end of the first day they will recalculate. So at the time we enter to the positions, the trade price of the forward is $1,450. However, by the end of the day is decreased $9 by $9 to 1,441. So it means that in that day we lose money because we are long positions, right? And if the price reduce, it means that we buy too earlier at a very high price at 1,450. So if we wait, by the end of the day the price will be lower to 41, but it's too late, right? So for us we lose $1,800. So it will be deducted from our margin account because this is our loss. So we start from 12,000 and now we have only 10,200 left, right? So in the next day the broker also help us to recalculate the loss again, and we lose more, right? So we lose totally in 2 days we lose more than 2,000, right? 300. So again it's also deducted by our margin account. But remember, this number is still higher than 9,000, so still is okay, right? So how about we continue this process until day 7, and you see that we also lose money now, right? So totally we lose more than 4,000 already. So if you look at the margin account, this is the first day since the beginning we lose more than 3,000. It means that your margin balance is below 9,000. So remember, 9,000 is what? Maintenance margin. So because you are lose below your margin balance now is below this number, you will receive a margin call from the broker to ask you put more money into your margin account. So in this case you need to go to the broker or go to the bank and transfer to the broker more money, some money to fulfill the margin balance. So in this case, how much money you need to pay? Because we need to recover the margin balance back to the initial level, 12,000. So in this case, you need to pay them $4,020. So you need by the end of the day 7, you need to have 12,000 in your margin account, and we continue this process. And people call this as a margin account daily settlement or a profit loss daily settlement. But the idea is that the daily profit and loss will be reflected into the margin balance accounts, and you will have the you can see the outcome every day, and you can it can mitigate the default risk of any side of the contract. Because if every loss, every daily loss can be reflected, and you need to pay. It will it will mitigate the concern that you will run away if you run out of money by the end, right? So it's very important feature that only future contract have this, and the forward contract we don't have this. In the forward contract, we just wait until the end of the contract to pay the money. So in that way, we can see that the future contract is less riskier and has a lower default risk compared to the forward contract. So I think that you will at home you can learn more about this example. I think it's a very important example. And the last slide, slide 15, I think is a very clear table to show you the differences between the forward and future. So you can read it by yourself, and whenever you have any problems, any question, you can email me or come to me in the class. So that is the basic idea about the differences between these two products. So it's important, right?